friends, this is Sahas Academy. We are presenting India Macro Market Analysis. It covers global and India-centric events impacting currencies, interest rates, equities and gold. So, let's begin with episode 1. Let's start first with global macro events. FOMC minutes. Several members are of the view that further policy tightening may not be necessary, whereas some believe additional rate hikes are warranted because progress towards 2% inflation target is too slow. Members generally agreed that risks to inflation remain tilted to the upside. On the other hand, tightening credit conditions due to bank failures remained a key risk to growth. Fed chairman highlighted that future policy decisions will be on a meeting-to-meeting basis. Impact of lag transmission of previous rate hikes and the effect of banking stress on credit will be key. The remarks were perceived as dovish by the markets, and as a result, the probability of a rate hike in June 2023 diminished post the remarks. Also supporting this, talks over US debt ceiling paused, raising worries of a possible default, which will further dent economic prospects. The May non-farm payrolls print will be a key data point for the June's policy rate decision. US debt ceiling. The US debt ceiling is center stage. As we race toward the implied 1st June deadline, the date by which US Treasury Secretary Yellen has suggested the government could run out of funds and default. The urgency of the situation is only going to intensify in the near term. Further, Treasury Secretary Yellen has reiterated that failure to raise the ceiling, leading to a US default, would be catastrophic for the global financial system. As per Bloomberg, Republican and White House negotiators are getting close to agreeing an extension of the debt limit alongside a 2-year federal spending cap. US rating downgrade. Fitch Ratings said it may downgrade the US's AAA credit rating to reflect the worsening political standoff that is preventing a deal to solve the nation's debt ceiling crisis. S&P has long back ascribed AA+ long-term foreign currency debt rating to the US. US macro data. The US macro data pointed to continued resilience in the economy. US new home sales rose by 4.1% to a 13-month high, pointing to continued revival in the housing sector. Flash US Composite PMI for May 2023 rose to more than one-year high at 54.5 from 53.4 in April 2023, led by the services sector. Jobless claims rose by only 4,000 to 229,000. Market was estimating the number at 245,000, suggesting that labor market strength remains intact. GDP growth for Q1 calendar year 2023 was revised upwards to 1.3% versus 1.1% estimated earlier. Manufacturing activity, however, remained muted. UK's GfK Consumer Confidence Index showed marked improvement. CPI inflation in UK moderated less than expected to 8.7% from the estimate of 8.2%, as core inflation rose to a 31-year high. In the previous month, CPI inflation number was 10.1%. Flash composite PMIs in both the Eurozone and UK signaled a slowdown in economic activity. In Eurozone, the number came at 3-month low at 53.3 versus 54.1. In UK, the number came at 2-month low at 53.9 versus 54.9. In Germany, IFO's Business Climate Index dipped to 91.7 in May 23 from 93.0 in April 23, led by a decline in future expectations. In Japan, Core CPI accelerated further to 3.4% in April 2023 from 3.1% in March 2023. Flash manufacturing PMI rose to 50.8 in May 2023, entering the expansionary zone for the first time in 7 months. It was 49.5 in April 2023. Services PMI too improved to 56.3 from 55.4 in April 2023. Now, let's move to the next section, India news and events. RBI has transferred dividend of Rupee 874.16 billion. Last year the amount transferred was Rupee 303.07 billion. Market was expecting dividend transfer of more than Rupee 1 trillion. RBI Governor Shaktikanta Das said that the decision to withdraw the Rupee 2000 denomination banknotes from circulation will have a very marginal impact on the economy. He further added that INR's exchange rate is very stable and currency management is robust, in an address ahead of a meeting with officials of public sector banks in New Delhi. RBI Governor Shaktikanta Das on Wednesday said, the Monetary Policy Committee would be guided by what's happening on the ground on the issue of whether to take a pause again or not in its next meeting in June, even as he expected retail inflation to ease further in May from April's 18-month low of 4.7%. The Finance Ministry said in its monthly economic review for April, India's economy is likely to see downside risks to growth and upside risks to inflation, partly due to challenges in the country's external sector as well as weather-related uncertainties. RBI's monthly bulletin stated that India's growth is likely to be driven primarily by private consumption, supported by reviving rural demand, and renewed buoyancy in manufacturing in the April to June quarter. JP Morgan has lowered down the inflation forecast by 70 bps from the RBI forecasted numbers to 4.4% and 4.7% respectively for the Q2 and Q3 of calendar year 2023, from the RBI forecasted number of 5.1% and 5.4%. This markdown is on the back of food deflation due to softening global food prices. However, risk to such forecast is below par monsoon. India's composite trade deficit continued to narrow. It came at $1.4 billion, which is at 2 years low. This is led by fall in goods and commodities trade deficit to $15.2 billion from $18.6 billion, and net services exports remain strong at $13.7 billion. Now let's move to our next section, market analysis. Let's start with USD/INR price move analysis. Very recent uptrend in the USD/INR is due to reversal in dollar index. The currency pair had taken a trendline support in the zone of 81.70 and started the uptrend, aligning with other emerging market currencies on account of dollar strength. It broke the 82.30 resistance zone and touched the high of 82.98 levels, which is also a strong resistance zone. Market closed the week at 82.57 levels, below the resistance zone. We have seen momentum is falling and expecting it will be supported at 82.35. The up move in USD/INR can also be corroborated with falling momentum in DXY uptrend in the daily price move. The weekly chart indicates further strength in dollar index. Next week is important. It will give us clue on further direction in the currency pair. Debt ceiling limit deadline is approaching. If debt ceiling limit negotiation move through, it will improve risk sentiments in the market. US consumer confidence and non-farm payroll data will give clue about further action by Fed on rate front. If we look at India's macro fundamental, which lends support to INR in case of extreme risk events. India's trade deficit is narrowing, which is good for the INR, though there is some weakness shown in FDI flows. As per RBI's GDP forecast, India's economy is expected to grow at 6.5% during the fiscal year with negative bias. At present, India's macro indicators are supportive with sufficient cushion in foreign exchange reserve, which are 593 billion US dollars as on 19th May. Further, falling global commodity prices and lower crude support India's macro fundamentals. Let's move to the next asset class, that is gold. Last week, we have seen further correction in gold prices. The correction is aligned with the strength in dollar index and fading rate cut expectations in US. Now, market is expecting long pause, though there are some voices of further rate hike to tame inflation. US macro data pointed to continued resilience in the economy. Former Fed Chief Bernanke said, "A tight US job market and rising wages are beginning to have more of an impact on inflation and could embed faster rising prices if the demand for workers is not brought into better balance with the labor force." If we look at charts, the prices have broken support zone of 1975 and taking a support at 1940 zone. In daily chart, next support is at 1930 levels. We believe that agreement on debt ceiling limit will be positive for risk sentiments and may take gold prices below 1900. In weekly chart, we look at immediate support zone of 1915 levels. Now, let's move to equity price movement analysis. An eventful week indeed. We started the week trying to analyze the impact of demonetization 2.0 and how it will impact liquidity. It seems most of the experts feel less than half of the rupee 3.5 trillion or thereabout in rupee 2000 currency notes will come back as sticky deposits in the bank, and rest all will go in high-value purchases. As equity trader and equity investor, we are concerned with liquidity. Monday, Nifty 50 opened at 18,200, and on Friday it closed at 18,491, with a solid 300 points gain, at this time of international turmoil and uncertainty. However, nobody knows how much of this is because of the newfound liquidity. The rupee 2000 currency notes have not yet come back fully into the system, and therefore any market activity attributed to this liquidity is purely an assumption. Towards the beginning of the week, RBI Governor exhorted banks to strengthen governance, and the very next day, retired Deputy Governor Mr. Viswanathan said that Indian banks are in good shape. However, these posturing and signal-making didn't make much difference to the performance of bank stocks. Bank Nifty opened on Monday at 43,935 and closed on Friday at 43,996, with a weekly low of 43,309, making a rickety hammer, almost looking like a dragonfly doji. However, in our opinion, the most important development of the week from equity traders' point of view is the culmination of Hindenburg-Adani saga. On Monday 22nd May, all listed Adani Group stocks surged ahead with biggest gains since January 2023, as it came to light that a Supreme Court-appointed committee did not find any material evidence to support Hindenburg allegations. As a result, during the week, Life Insurance Corporation of India, which had earlier faced erosion of notional value of its total equity holding because of post-Hindenburg Adani Group stocks tanking, found 54% increase in value of its Adani Group holdings. But the most charming news to the ears of the Indian investors came from Chris Wood, Global Head of Equity Strategy at Jefferies. Chris said that there is nothing in the Hindenburg report that he didn't know already. The Adani Group had real and quality physical assets. And on top of it, he claims not to have reduced his holding in Adani Group post-Hindenburg report. It looks like a lesson for Indian investors to do their own due diligence and not suddenly react to any such report if one is a long-term investor. All conspiracy theories are not mere theories, some of them may be genuine conspiracies. From the weekly chart pattern of Bank Nifty, it is clear that after continuous 7 weeks of up move in a rising channel, the last two candlestick pattern representing the previous week and the week just gone by shows clear sign of weakness. The two consecutive hammers indicate some kind of tiredness. Either Bank Nifty will go through a time correction or a value correction. Possibility of the latter is more. Nifty 50 though is telling a different story. If one sees carefully the rising channel in the weekly chart, there is bearish candle that formed in the previous week. In the week gone by, till Thursday, it was giving indication as if the week will end forming a shooting star and inverted hammer. However, Nifty 50 gained 180 points on Friday and made a solid green candle for the week. That is almost looking like a bullish engulfing. Monday's opening will be very crucial. If Nifty goes up and away from 18,500, then any trading strategy centered around Nifty correction needs to be revisited. Let's move to 10-year government securities price action analysis. Last week we have seen yield in 10-year segment traded in a narrow range. A week prior, yield touched 6.94 levels on expectation of higher dividend from the RBI. RBI has transferred dividend of Rs 874.16 billion. In the previous year, the amount was Rs 303.07 billion, whereas market was expecting dividend transfer of more than Rs 1 trillion. RBI's announcement led to market sell-off. 10-year government security was moving around 6.94 level, but after the announcement, there was some sell-off seen in the market. There was a statement from senior finance ministry official on no change in borrowing program despite higher than budgeted dividend transfer. 10-year government security closed the week at 7%. This move was also coupled with rise in US Treasury yields. As discussed earlier, in US, market was expecting rate cut cycle to start soon. However, strong US macroeconomic data and Fed's commitment to achieve 2% inflation target dashed market hopes. If we look at US yield curve, we could see the upshift in the curve. However, in India, yield has shifted downward from the March levels. In fact, Rs 2000 note ban and further rate hike expectation in US has led to curve steepening. We have seen shorter end of the curve has rallied due to the note ban announcement. If we look at charts, it suggests that 10-year India government securities to touch 7.08 levels. However, any risk event may take 10-year government security yield higher. Next resistance zone is at 7.18 level. Here we wrap our discussion. Thank you for watching the video. If you have any suggestion or feedback, you can reach us at info@sahasacademy.com or visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you. Disclaimer. This video is made for educational purposes. It does not constitute an advice. Please consult with your investment advisor before taking any investment decision.